Lesson 3, the 3 steps to successful investing. So in the previous lesson, you learned the simplest way to invest in a market is to simply buy an ETF that tracks an index, so that you're buying the 30 or 500 biggest companies in the market. But of course, if you do that, then you're just getting market returns. But the purpose of this course is for you to learn how to beat the market, how to get much higher returns than what the index provides. So from here on, we're going to focus on how do we pick individual stocks that outperform the market. So let's begin with this broad concept, which are the 3 steps to all successful investing. Now, this is going to be a relatively shorter lesson because I want you to first understand the broad concept. And once you understand it, in the subsequent lessons, we're going to go into the details. So if you are ready, let's begin. All right, so step number 1, the first step to all successful investing is you have to identify the great businesses. Remember, when you buy a share of stock, you are not buying a lottery ticket. Like I said earlier on, you're buying a piece of a business. You're owning a business. So what businesses do we want to own? We only want to buy great businesses. We're not interested in mediocre businesses. We're not interested in lousy businesses. We only want to buy great businesses, the best of breed. Now think about it. In the US market, for example, there are over 10,000 businesses. And we've got the choice to buy any one that we want. So why waste time with the low quality businesses when you can just go for the great businesses? And I would say that I only focus on the top 1% of the great businesses and ignore the 99%. So again, that's step 1. Now step 2 is once you identify a great business, you only want to buy that business when it's selling at the right price, when it is selling below its intrinsic value, when it is undervalued. Why? Now remember, a great business can be a lousy investment if you pay too high a price for the shares, if you buy it when it's overvalued. But again, a great business becomes a great investment only when you can buy it for less than what it is worth. It's the same for any asset. For example, let's imagine that you find a great apartment, a great property that's got a great view, great location, it's a fantastic property. Now the bank does a valuation for the property and find that it is worth $1 million. But you get so excited about the property because you love it so much and the seller's asking for a very high price. You thought, you know what, I'm just go buy it, right? So you pay, say, 1.5 million for the property. So is that a good investment? No, because you paid 50% above the valuation. And chances are it's going to be pretty hard for you to make a profit on that property. But eventually, yeah, you may, but you won't get a very high return because you overpaid for it. But what if you or what if the seller was very desperate? For some reason, he was unfortunately getting a divorce or he lost his business and he had to get rid of the property, he needed the cash. And he said, you know what, okay, you take it for $700,000. And you go, yes, right? So you buy the $1 million property for 700 grand. So is that a great investment? Yes, because you paid 30% less than the intrinsic value. Now, does this happen in real life? Yes. But in the real estate world, it's really hard to find a great property with a desperate, motivated seller. It's really hard to find. You can find it, but it takes a lot of effort. But the great news is that it happens all the time in the stock market. In the stock market, you've got high quality businesses that often, now I wouldn't say every day, but happens at least once a year or every few years, where a great business goes on sale, where it's selling at 20, 30, 50% discount because there are desperate sellers in the market who are panicking because of bad news. And you can buy a great business at a huge discount. And I do that all the time. So that's how I got really rich. And that's how people like Warren Buffett got really rich, right? So that's step 2. Invest when the share price is below the intrinsic value, is undervalued. And ideally, the price has what we call wave down to a support level. Now, what's a support level? A support level is a technical analysis term, which you're going to learn more of in lesson 6. It's a price level where the price drops to that level, and there's a high potential for it to reverse and bounce back up. It's called support level. So you're going to learn how to identify all these support levels, how to calculate intrinsic value in these subsequent lessons. Now, can you guess what is step 3? Now, you may be thinking, yeah, step 3 is when do I sell? Now, here's the thing. If you have done step 1 and step 2 very well, you shouldn't ever have to sell. I'm not kidding. Think about it. If you really identify a great business and you bought it when it's undervalued, you should never have to sell that stock until you need the cash to pay for something. Because if you don't need the cash to pay for something, you should stay in that business, because if it's a great business, it keeps on growing and compounding your wealth. And if you sell that great business, you have to take that cash and reinvest it in another great business, which is not easy because there are not that many great businesses around. So once you latch onto a great business, like having the perfect wife, for example, you want to hold on for the rest of your life until such time that, again, you have to sell some of it to pay for something. But if not, you want to stay invested. So let's take a look at several great businesses. For example, if you own Apple for a year, then you would grow your money at anywhere from, say, 16% to 35%, depending on where you sell it. But if you held on to Apple for the last 5 years, for example, your wealth would have grown at 191%. If you had held on to it for 10 years, it would have grown 792%. If you held on to it for the last 20 years, it would have grown at 22,830%. So you can see that the big money is staying invested in a great business and letting it compound your wealth massively. That's how you make the millions. That's how you build the generational wealth. You don't build generational wealth by taking profit at 20%, 30%, 50%. You want to 10x, you want to 15, you want to 20x your money. And that's why you want to hold great companies. Now, let's take a look at another example. Let's say MasterCard, another one of my stocks I've been holding for many, many years. And again, if you hold MasterCard for a year, your wealth will be growing at, say, again, about 20%, right? But if you held it for the last 5 years, it's grown at 68%. If you held it for the last 10 years, and again, this is despite all the crashes, the COVID crash and the 2022 bear market and the trade war, despite all these crashes, and you held it for the last 10 years, it's up 563%. And if you held it for the last 20 years, again, despite all those recessions and crashes and stuff like that, and the great financial crisis in 08-09, you're up 6,000%. Another one of my biggest holdings is Nvidia, which of course is the leader in the AI revolution. If you held Nvidia for 1 year, you're up 144%. If you held Nvidia for the last 5 years, you're up 2,200%. If you held Nvidia for the last 10 years, despite, again, all those crashes along the way, you're up, 2015, right, 10 years, you're up 29,615%. Now, of course, it must be a great business. I keep emphasizing it. If you buy a low quality business or an average business, then you don't want to hold it for very long. So, for example, if you look at American Airlines, which is a lousy business. By the way, all airlines, write this down, all airlines are lousy businesses. It's not the fault of the management, it's the nature of the industry. Certain industries are just not very profitable. Like, for example, the airline industry, for example, or the property development industry. They're just not great businesses by the nature of the industry. And if you put in, for example, American Airlines, and you held it for, say, a year, then okay, you get 33% return, right? But the longer you hold it, the worse it gets, okay? So if you held American Airlines for 5 years, you would have lost 33% if you held it for 5 years. And if you held for 10 years, you can see you're down 60%. So the longer you hold it, the worse off you are. So you got to hold only great businesses. Only great businesses compound your wealth over time. Mediocre businesses, lousy businesses stagnate your wealth over time, or they reduce your wealth over time. Now then your question is, how do I know it's a great business? We're coming to that. Hold on. Now, of course, like I said, in a perfect world, if you bought a great business, you bought it cheap, you never want to sell it until you need the money, right? But we don't live in a perfect world. So there are times that we have to sell our shares of a great business that we bought. So we sell an investment when the fundamentals of the business have deteriorated. Now, when I say fundamentals deteriorate, I don't mean short-term drop in profits or short-term drop in sales. No, that's a cyclical fact, right? That's very normal. When I say fundamentals deteriorate, means the long-term business model is disrupted or the company loses its competitive advantage. Then we got to get out. We got to get out of that business. And again, in the lesson on exit rules, I'll go into detail. How do we know when a great business is no longer great? Like, there were great businesses in the past, like Intel was a great business many years ago. General Electric was a great business many years ago. Not anymore, because over time, they lost their competitive advantage. Their business got disrupted. And the moment you start to see that, you got to get out and reinvest into a great business because it's no longer great, right? At the same time, we can also exit an investment of a great business if we feel that, yeah, it's great, but there's an even better business. Then we could sell that and reinvest in an even greater business. And again, we'll cover all that under exit rules in the subsequent lessons. Or sometimes, even if it's a fantastic, great business, you may still want to sell if you feel that the share price has gone too crazy. In other words, the price is way overvalued, is way too expensive. Nothing wrong with selling, part of it or even all of it, and then just taking cash and waiting for it to get cheap again or to reinvest it in a great business that's more attractively priced. So again, all that will go into detail, but I wanted to understand the broad concept here. So let's answer that first question, which is, so what makes a great business? A great business is one where you are confident that over time, in the next 3, 5, 10, 20 years, the business will consistently increase in value. So if you take a look at this green line over there, this represents the value of the business, what the business is worth. Also called the intrinsic value of the business or the intrinsic value of the shares of the business. Why? Because as the business increases in value over time and the business is worth more and more, then people are willing to pay more for the business, and hence the share price will go up over time. Okay? Then the question would be, okay, so what makes a business more and more valuable? Ultimately, what's a business? A business is a money-making machine. I've said this before. And the more money it makes, the more it is worth. All right? So in other words, what makes a business more valuable is when the business consistently makes more money. So when the business generates increasing sales revenue, net income, also known as earnings, and increasing cash flow from operations, the business intrinsic value will keep rising. So how in the world would you know whether this business you're buying is going to keep increasing their revenue, profits, and cash flow in the next 5, 10, 15, 20 years? How would you know? Well, there are certain criteria I look for that give me a very high probability of this happening. And you are going to learn these 5 criteria in detail in lesson 7 of this course. So let me give you some ideas of these 5 criteria that I look at, right? Number 1 is a track record. A great business has a track record of at least the last 5 to 10 years, showing that it's able to increase its revenue, its net income, and cash flow from operations consistently. But again, history does not predict the future. It's not good enough, right? So criteria number 2, I ensure the business has got a sustainable competitive advantage that protects it from competition. We call that an economic moat. I look for businesses that have got high return on equity, high return on capital. So the management is extremely efficient. I look for businesses with strong balance sheets, with low conservative debt structure and high levels of cash. I look for businesses with strong growth catalysts and drivers. So when your business can meet these 5 criteria, which is very rare, in fact, like I said, less than 1% of businesses in the market meet these 5 criteria, but when they can meet these 5 criteria, it is highly likely it's a great business. They will keep growing in value over time. So companies like American Airlines, they fail these criteria. Companies like Microsoft and Nvidia and Apple and MasterCard, they meet these criteria. So here are a few more examples of great businesses. So again, Microsoft, just mentioned it, right? So Microsoft meets these 5 criteria, and you can see that over time, the intrinsic value of the business keeps going up, okay? But I mentioned again in lesson number 1 that although the business goes up in value, but the share price, the price which you pay to buy or sell, does that go up in a straight line? Does that always reflect the value of the business? No. Again, why? Because the share price is determined by demand and supply in an auction-driven market. And in the short term, the market price is not driven by logic all the time. It's driven by news and emotions. So because of the news and emotions, you got times when the share price goes below the intrinsic value and it gets undervalued. And there are times when there's good news, there's euphoria, there's excitement, and the price goes up way above the intrinsic value, it gets a bit overvalued, right? And then you got bad news again, you got pessimism, then it gets undervalued again, and overvalued and undervalued. So it's kind of like a pendulum that goes from overvalued to undervalued, and this pattern keeps repeating. And these are times when the share price gets very far from the intrinsic value that we have got mispricing. And it is how we take advantage of the mispricing, that's how we get really rich in the markets. So again, another example, if you take a look at Visa, is this a great business? Yes. Why? Because over time, it keeps making more money, it keeps increasing sales, profits, and cash flow. So over time, the intrinsic value of Visa keeps going up. But look at the share price. The short-term share price, again, is driven by news and emotions and manipulation. And it gets mispriced ever so often. It gets really undervalued, gets overvalued, undervalued, overvalued, undervalued again, and then overvalued, and then undervalued, and then overvalued. I read an interesting analogy about how the market works. That it's kind of like a man who is walking from point A, from his house, to, let's say, to his office, for example, right? And he walks in a straight line. But this man has got a dog on a leash, and it's a pretty long leash, and as a result, as the man is walking towards his office, for example, the dog runs all over the park because the dog's really excited, and sometimes the dog will run all the way to the right, and the dog will run all the way to the left, and you don't know where the dog is going. You've got no idea where the dog is darting to. It's kind of like the market. In the short term, the market is very random. You have no idea, is it going up, going down tomorrow? You don't know where the dog is running to, depending on whether he sees a cat or whether the dog sees a tree, right? But eventually, what happens? Eventually, the dog will meet back with the man when he reaches his office because the dog's on that leash. So once again, step 2 is we patiently wait for the stock price to go below the intrinsic value, the green line. And again, in lesson number 5, you're going to learn all about how to value stocks of businesses. Different businesses, we value them a bit differently, right? So again, look at this green line. Our job is to wait for the price to go below the green line, and that is when we start to ideally add what we call, again, support levels, which you're going to learn how to draw these support levels in lesson number 6 under technical analysis. Now, as I've mentioned before in lesson 1, do we have to buy right at the bottom of every correction or of every wave down? I would love to, but no one can predict the exact bottom. So all we got to do is, as long as we buy below the intrinsic value, that's good enough. We've done our job. And you will learn later on that when I buy, I never buy at one go. I always buy in 3 to 4 or even 5 tranches. So in other words, once the price goes below the intrinsic value by a certain margin of safety, say by about 10-15%, I would start to add some shares at the support level. But then if it goes even lower, then what I'll do is then I'll add even more. When it drops, say 20% below the intrinsic value, and then it goes even lower, then I'll add even more. So I will slowly average in the position. It's kind of like dollar cost averaging, except that we are adding at support levels. So you're adding a bit here, a bit here, a bit here, for example, then your average cost could be maybe somewhere about there. That's your average cost. Again, it's not at the bottom, it doesn't have to be at the bottom, because as long as you buy below the intrinsic value, over time the price will get back above the intrinsic value, plus the intrinsic value itself is increasing. That's how you see growth in the value of your shares. Like what Warren Buffett said many, many years ago, the time to be greedy is when others are fearful, and the time to be fearful is when others are greedy. So again, the question is, if a business is so great, why is it selling at a discount? It's the same reason why sometimes you can find a great apartment, but you can buy it at a discount, because for some reason, the owner of the property is desperate to sell because he's in trouble, so he's got to sell that property. So same thing, there are many people in the stock market where at times they are desperate to sell. They are panicking because of emotions, or they are forced to sell by their broker because they were on margin. We don't care. We don't care why they are selling at a discount. All we do is we take advantage of the fact that it's selling at a discount. But these are some common reasons why a stock may sell below its intrinsic value. And let's run through these reasons. The first reason could be an overall stock market correction. So what happens is that on average, once a year, the whole market will drop, okay, on average once a year by at least 10%. And there's always a reason to trigger the drop. You can never predict the reason, but there'll always be a reason. For example, it could be a war, could be a disaster, could be geopolitical tensions, could be tariffs, could be weak economic numbers. We don't care, whatever, right? But whatever it is, the market will drop on average 10% once a year. And when the market drops, guess what? Most companies will all go down together. Where the good companies, bad companies, they all go down. So those are the times you want to buy the good companies that are going down, because the market drops has got nothing to do with the company. It's because of the overall market sentiment, and that's a great time to buy a great company. Second would be a bear market. So again, the difference is that a correction happens more frequently, and a correction is when the market drops more than 10%, but less than 20%. A bear market is when the market drops more than 20% from the high because of usually a recession or an economic crisis or some financial crisis that happens from time to time. We can never predict when it's going to happen, but it will happen from time to time. Again, if you look at the last 100 years, it happens on average once every 6 years. Again, it's not a perfect occurrence every 6 years. There were times when, for example, from 2009 to 2019, for 10 years, there was no bear market. No bear market, right? But then from 2020, there was a bear market. 2022, there was another bear market. So sometimes they come together, sometimes they can be really far apart. We don't know, right? But again, in a bear market, what happens? Everyone panics. Everyone loses their mind. And good companies, bad companies, they all fall 20, 30, 40%. And that's how you can buy a great company at a discount when there's so much fear in the market. So I love bear markets. I love it. After every bear market, my portfolio grows exponentially because I get to add shares at huge discounts. The third reason why a stock goes below the intrinsic value is because the stock is within a sector or within an industry that is unloved, or we call it out of rotation. Now recall that in lesson number 2, there are altogether 11 sectors in the market, right? You've got the technology sector, the financial sector, healthcare, so on and so forth. And within each sector, like technology, you have got different industries like semiconductor, hardware, software, whatever, right? Now, the interesting thing about the markets is that sectors take turns to be loved and unloved by investors, right? So when a sector is loved, then money goes into that sector. A lot of investors, institutional investors, put money into that sector. Say they put money into the financial sector. So when money is going to the financial sector, we say that financial sector is in rotation. So when that happens, most of the stocks or all the stocks in the financial sector will go up. The good, the bad, the ugly will all go up. It's like a rising tide lifts all boats. Okay, but when money goes into the financial sector, it has to come out from somewhere. So maybe it's coming out from the healthcare sector. So when money is flowing out the healthcare sector, we say that healthcare is out of rotation. It is unloved. And when that happens, all the healthcare stocks, again, good, bad, ugly, they will all drop. All right. So this rotation keeps happening. Again, it's almost impossible to predict exactly when it's going to rotate and when it's going to rotate the other way. So my job is not to predict the rotation, when it's going to happen. My job is to take advantage of the rotation. So let me give you an example, right? So in 2024 especially, and in fact in 2023, healthcare, the whole healthcare sector was out of rotation. It was unloved. All the money was flowing out of the healthcare sector because of various reasons. Number one was because of politics. Usually in an election year, the whole healthcare sector, money flows out because there's uncertainty over new political regulations, right? And there were other reasons. For example, because of COVID, that caused a lot of people to delay their non-essential surgeries. And after COVID, they all go for their surgeries. That increases the cost of insurance companies, people who make claims for their surgeries, and so their cost goes up, their profit goes down. So many reasons, right? But basically in 2024, healthcare stocks got very, very cheap. And that's the time I bought healthcare stocks, when they are unloved, when they're cheap. Because that's how I get it at a discount, right? And then later on, eventually, once people get excited about healthcare again, money flows back, that's how you get 20, 30, 40% returns. Because let me answer this question. In the long run, will the healthcare sector do well? Yes, because in the long run, everyone needs healthcare. And in fact, healthcare is a recession-proof sector. And in the long run, we've got an aging population, people are growing older, it's a long-term growth driver. Another example I can give you is in 2024, consumer staples sector was unloved. What are consumer staples? These are companies that sell what we call low-growth essential goods, like again, Coca-Cola, Pepsi, Procter & Gamble, Colgate. These are very low-growth essential items, and they are very defensive stocks. They are recession-proof. So what happens is that when the economy is doing very well, people don't want to buy all these boring companies, so they sell them. That's why they tend to drop during good economic growth. And when they drop, they're cheap. That's when I buy it, right? So in 2024, I bought a lot of consumer staple stocks. I bought Pepsi, for example. I bought a lot of healthcare stocks. In the near future, whenever there's a fear of recession, and we don't know when, but when there's a fear of recession, guess what? Then everyone gets scared. They start to buy healthcare again. They buy consumer staples again, and then that will start to fly, right? So I take advantage of this kind of rotation.